Hello and welcome to FinTech Diary. Every week, we speak to an industry expert who's part of the FinTech revolution. In the world of FinTechs, which is based on constant evolution and innovation, we question change makers. How do they plan ahead and read the future developments? The focus of the FinTech Diary is to get the breadth and depth of every segment related to FinTech in every chapter that we have. My name is Amol Dethi, and my guest for this particular chapter is Mr. Bhavin Patel, founder and CEO of LenDenClub. Bhavin, glad to have you.
Thanks, Amal. Really glad to be on the platform. I have been tracking you for ages, and probably it's really good fortune for me to interact with you on this platform.
Thank you so much for the kind words, Bhavin. So let's begin with your story first. So what has happened in the fintech space in last couple of years is the rally has been aggressively shifting towards credit. Maybe the fintechs in payment space realize they cannot make money over there, and perhaps credit is far lucrative for them. And you are also heading towards the credit space, which is the peer-to-peer lending in NBFC space. So to begin with, Bhavin, when I was going through your website, it says that you have 25 lakh plus customers, 10 lakh plus investors, and you have already disbursed more than 2,000 crores of loans or amounts. So my simple question to you is, have you made money? Did you make any profit?
Yeah, definitely. So since inception of LenDenClub, we have been always focusing a lot on how we earn money at the unit level as well as how quickly we can reach to profitability. So last financial year, FY21, we closed on profitability, and this year also will be registering profit. Yes, we are on that track. Regarding the numbers which you mentioned, yesterday only we crossed 5 million users on our platform, which includes both investors and borrowers.
Okay. Noted your points, Bhavin. 5 million user is a what you can say a good achievement to have. Uh, but how has been the competition now in the credit space? Because every fintech, I'm not even saying every alternate fintech, which was the case 2 years back, but today every fintech wants to have a pie of the credit chart, right? So how are you dealing with this competition and how are you heading ahead?
So as you rightly said that there are new entrants coming into the market, and new entrants are bringing new models in the market. So again, giving back to your reference point when you initiated the discussion, that the first rally was on the payment side. So payment was a basic necessity for any digital creditor to come into place. So payment set a platform that in India we can do online payments, we can do collect online payments right from the borrower's back, which was not available earlier. But now because that basic infrastructure is available, for a lot of digital lenders like us can come up with various new products which are operating only through digital medium. So traditionally, when more credit was being distributed via offline mode or physically, there were always limitations that how many number of branch you can open, how many number of people you can employ, sales people, collection people, verification people. Those barriers have been broken now. So payment set up the basic platform. Now new entrants and new players like us are bringing new models into the business. What we foresee, what we saw over last 3 4 years and what we are foreseeing over next 5 to 10 years is earlier people used to take credit in a wholesome way, that somebody takes a personal loan of 5 lakh rupees and then spend it at various stages or across various requirements, like he will purchase something, he will go on vacation, etc., etc. Now that pattern has changed. That pattern has now converted into something like, if I require to purchase a phone, I look for only 25,000 rupees loan. I will start repaying that from the very next month. After 3 months, if I require money for going on a vacation or a break, I will again take a small amount of loan, then again repay it back. Right. So that consumption pattern of credit related products are being changed. And that's the reason the traditional products which were available in the market are not as attractive to the new users. So still the market is growing for the traditional product, but there is a huge scope for new kind of products are coming up, and that's the reason you are seeing that every frequent basis new players are coming into the market. They are doing a lot of innovation in terms of product, etc. However, what we have seen in last 2 3 years is majority of the innovation has happened on the unsecured lending side. However, I predict that in next 2 to 5 years, a lot of innovation is going to happen on the secured lending side as well. As far as the competition part is concerned, as I said that all these new players are bringing new models. We are not competing directly with each other, but I think we are creating our own new market or niche markets, where today we are not facing the competition. Maybe 1 2 years down the line we may start looking at each other as a competitors.
Okay, I think valid 2 points, that unsecured to secured and creating our own niche. I think that's what, the perspective that you're offering on a credit system. Sounds good, Bhavin. Let me go ahead and, ask some specific questions now, since you mentioned that you have 5 million customers already. Uh, you know, I mean, unlike listed companies where all the data that you have to share with the regulators, and for us also it becomes easy to judge the company. But, what I would like you to tell us is, out of these 5 million customers, or whatever the customers that you have right now, how many are the repeat customers in terms of investors and in terms of the borrowers as well? Are the borrowers maybe coming back to you again and again whenever they are in need, and also the investors? Because I think that will be a great metrics to find out whether you are having the sustainable growth or not, right?
Right. Absolutely. So on an average, borrower takes 2.6 loans from our platform. That's the repeat ratio which we have seen from on the borrower side, where we have disbursed around 6 to 7 lakh number of loans to these customers. In On an investor side, around 42% of our investor remains invested even after 12 months. So we have two base product, 12 months and 24 months. So people once complete their 12 months investment period, they still continue to be invested on the platform, and that is 42%, which shows that there is a good enough adoption of this instrument, and also people believe that they have generated quite good returns, and that's the reason they continue to be invested on the platform.
Meaningful thoughts, Bhavin, there. But now my question to you is specifically about the NPAs, right? Are you also witnessing the bad loans there?
So see, historically, our default rates have been varying anywhere between 3% and go as high as around 6%. Currently, stabilizing around 4%. And we also publish our historical default and rate of interest data on our website as well, so that the investor which are coming on the platform knows that there is a possibility of movement in the number of defaulters or NPA data possibility. However, in either case, the lowest or the extremist case as well, we were able to return good. I mean, we were able to provide 10 to 12% returns to our user. And the most stress scenario we had seen was during the financial year when we faced COVID-1 lockdown, which was between April to June 2020. So during that period also our default rate climbed up around 6%, and then again it has now come down around 3.5%.
How has been you? How are you actually managing your collections? Because what I understand is, I think all the fintechs, like you are the digital lenders specifically, if we use that term, have adopted or embraced or must have developed a robust system when it comes to disbursals, right? But
Right.
the collection or maybe the repayment is ultimately depending on the borrower, right? So how do you actually, ensure that your borrower is paying on time, your collections are in the process?
Right. So see, we generally maintain 7 to 10 days worth of liquidity on the platform, because the money or capital is flowing from individual or HNI investors like you and me. All right. So we always ensure that whatever disbursements are required over next 7 to 10 days, that much liquidity is available on the platform. So by doing that, we are able to achieve 24 hours commitment to borrowers, that the moment you complete your loan application, we will be able to disburse money within 24 hours time period. And for that we use various algorithmic verification of the user data. Our approval is completely algorithmic. Around 85 90% of our loans are approved within few seconds to few minutes, where all verification checks balances are taken place via systems only. Right. So we are able to achieve by maintaining the liquidity and ensuring that we use all digital processes to complete verification of the borrowers. So that's how we manage that part.
Okay, noted your point. So I, fairly understand the peer-to-peer lending model, but since you're operating in that space, you also have an investors, and you also raise funds for the operations and all that purpose. So I just want to understand, maybe, and if you could enlighten us on that part. Are you lending the funds that you only borrowed from the investors, or you also use your own funds to lend to the customers?
We don't use our own funds because that's a clear conflict of interest for the platform. Right, those kind of things can bring biasness in terms of collections or uh, investment into a specific type of borrower. So to avoid that, we don't do that, and that has been prohibited by RBI as well as at company level. Also, we maintain that position. In terms of usage of capital, that comes completely from the investors only, who are individual or HNI. So they bring on capital on the platform, and that capital is being in giving credit to the consumers which are coming to us.
Have you ever witnessed a mismatch between the fund that you receive from the investors and the demand that you have from the borrowers? Have you ever seen a mismatch over there?
Many a times. So
Mhm.
it's a business, right? So for example, the way we witness such kind of scenarios on exchanges, NSE, BSE, etc., that sometimes there are upper circuits, sometimes there are lower circuits, because there is a demand mismatch. When somebody wants to sell but buyers are not available, similar situation happens on our platform as well. But being an exchange, it is our part that we ensure that more and more investors are coming onto platform in case there is a crunch on the liquidity side. At the same time, if borrower crunch is going on, then we try to hunt more and more possible borrowers whom we can approve, and investors get a chance to do it. But still, as there are certain processes and the guidelines to select borrowers as well as to bring investors on the platform,
Mhm.
definitely we can't bypass those. So such kind of scenario comes in. Likewise, when the second lockdown hit, we were too much positive on the capital side, but we were unable to deploy a lot of that capital because April and May were washed out in terms of demand of loans because of a severe corona virus issue. We can't help it with the situation, so that money will remain idle on the platform for some days. But our investment algorithms are defined in such a way that then it tries to optimize the returns at the individual lender portfolio level, so that the targeted rate of 10 to 12% on an annualized basis can be achieved.
Mhm. So could you spend maybe 2, 3 more minutes and explain us how does this work? Because there could be a situation where investors have given you money. Let's take an example that you just shared during the unprecedented event like COVID, but there are no borrowers. But the investors must be expecting whether you lend to the borrower or not. Ultimately, he has given you money and he must be expecting an interest rate over there. On the other part, you haven't given the money to the borrower, so you cannot charge them an interest. So how do you actually then convince the investor, or or you don't give them any interest till lend to the borrowers? How does that work?
So see, the communication which goes out to investor is they can expect 10 to 12% kind of returns. At the same time, the lending rate remains little bit higher. And when we calculate what can be the ultimate returns on invested capital to the lender, we also consider there is some buffer period, which is around 15 to 20% of the invested period. So let's say if it is a 10 months period, then we consider that buffer could be as high as 45 to 60 days. So even if that buffer period is available when money is idle, still lenders will be able to look at 10 to 12% kind of return. So all these probabilities are built in our algorithm, and 99.9% of lenders on our platform make investment via auto invest algorithms only. So that's the reason system is able to optimize investment. So there will be certain idle period, but at the same time the churning will be much higher as and when there is opportunity to invest that money. So system itself optimizes investment. So and it also tries to neutralize the variation of returns between the investors. So let's say Amol and Bhavin invested at the same time for 12 months. After end of 6 months, there is a difference of return between Bhavin and Amol. So let's say Amol is getting around 14% return, Bhavin is getting around 8% return. So portfolio optimization algorithms automatically adjust the future investment in the portfolio, and that tries to bring both the portfolios between 10 to 12% kind of net returns by end of the 12 months. And these are completely independent AI-based algorithm where there is nobody who can do any kind of modification. So because of such kind of systematic approach, and there are certain rules and there are certain probabilities which are already considered while building these algorithms, we are able to achieve the expected returns at the lender portfolio level, even if there is any crunch of borrowers, and similarly vice versa, when there is a crunch of capital, at times it becomes difficult to manage the expectations of the borrowers. However, that side, so far we have not been facing huge amount of crunch. The majority of the pressure remains on the capital side only, that more capital is available on the platform, but for deployment you have less number of borrowers. So that's how we have resolved that bigger problem.
Hmm. Okay. Noted your points, Bhavin. Since credit has been, the season, in the flavor of the season right now, as we discussed, all the fintechs are entering in this space, and you have been already operating in this space since last 6 7 years now. What is the biggest challenge that you see in the credit space?
So I think the biggest challenge at this moment is how we can use technology more and more efficiently as and when scale is going up. So we believe that today, whatever stage we are, at least for next 4 to 5 years, the continuous innovation and the expansion in technological product is going to be the biggest challenge. So more growth we are registering, we are feeling that technology is going to be differentiator, and how you push yourself more towards it. So we believe that the biggest differentiator will be technology, and to achieve technological advancement, you have to keep challenging yourself. So as I said, that we are focusing and looking into more and more technological development, rather than thinking ourselves as a finance company which is using technology just as an enabler. So I mean, I wouldn't be wrong if I say that we are TechFin, which started as a finance company using tech as enabler, then became fintech, and now it is TechFin.
Where is credit market heading right now, according to you?
So I put a very simple calculation, right? Very basic mathematics, that today India is at the juncture where we are 3 trillion economy with 15 to 16% of per capita debt, household debt, not even per capita, household debt. So if we have to become 5 trillion economy, this household debt has to go to at least 20 to 21 percentage, 6 percentage. It's almost 40% of the current household debt level which India is at. And if we compare it with how the other economy grew, like China at 13 14 trillion size, they had around 40% of the household debt at the economy level. US at around 25 trillion level, they had roughly around 55-60 percentage of household debt level. So India is bound to go into that direction. So let's say from 3 trillion to 5 trillion, it is going to be 21 percentage. So this 6 percentage is a huge jump, and this 6 percentage will not only be achieved via traditional lending products, and that's where the more and more innovative product and adoptable product requirements are coming up. Again, it is not only in terms of unsecured loans, it is also coming up in secured lending, it is also coming up in microfinance, it is also coming up in product like agri finance, structured finance, logistic finance, bill discounting, everywhere. So I believe this additional requirement will be majoritarily fulfilled by new age technology companies, or via maybe bank network, but they will also work very closely with new age fintech companies to reach out to this customer and fulfill their requirement. So we are betting on this additional 6 percentage, and that's a very huge portion.
Okay, I think you dotted down your points really well, and what you can say, serve that gap which is there in the system. Noted your points, Bhavin. Tell me something about the finances of LenDenClub. How many rounds of funding has been taken place at LenDenClub? Do you still have the investors, those who are the seed investors at your company? They're still holding their stake till now.
Right. So, see, we raised 4 rounds of investment, the latest being in the month of December, where we raised 10 million worth of funds in our Series A round. Before that, we had 3 rounds, two pre-series and one seed investment. So, for seed investors, we have already arranged exit before last round. And any investor who entered into the company at pre-series level, they are still invested in the company.
What about next rounds of fundings? Are you looking for any new round of fundings now? What would be the size? Any what you can say, average ticket size that you want to share?
So right now it will be little bit unpredictable for me, more speculative. So at this moment, the focus for us as a company is to build team. We have almost completed building our complete team, and now next focus is going to build real value. That whatever funds we have raised so far, how can we start leveraging those funds and build more and more numbers. So we are already at 4 to 5 times of growth since when we were valued last time. But at this moment, I mean, we have enough funds available, and we believe that still there is a growth opportunity available. So focus is completely there.
Any rough estimation in terms of when will you become a $1 million, $100 million company?
No idea. Probably investors will be right people to comment on this.
Okay, noted your points. Bhavin, last question now specifically about LenDenClub. Considering you have enough rounds of fundings and you will go obviously in future also go for the another rounds of fundings, we can see the number of customers, the borrowers are increasing on your platform, and we can see also the competition or the new number of players in the credit space is also coming up, which simply means that this space is showing some charm or showing some, what you can say, ambitious growth for the future for sure. Where do you see LenDenClub going ahead, maybe in next 2 to 3 years? Or what are your, future plans for LenDenClub? Because ultimately, what I see is every startup is dreaming of becoming a new unicorn, right? And it's not just a unicorn tag they want, but after that, now there is another hope of getting listed or carrying another tag of an IPO. But then the challenge is, different when you go to the secondary market. So again, we'll talk to that topic a little later. But what is your future plans right now? How do you see the future for LenDenClub right now?
So I think long-term ambitions are really good, and that gives some kind of direction to the company. Now, either it is in terms of valuation of the company, or in terms of disbursement growth, or in terms of some benchmark that what we want to achieve, right? So at lending club level, we always look at what we want to build within the company. So one benchmark which we earlier had was when we will reach 1,000 crore disbursement mark, right? So that we already achieved during the current financial year. Now the next disbursement mark which we want to achieve is 7,500 crores. So that will make us a company which has already disbursed loan worth of $1 billion, right? So I don't know whether how it will correlate with valuation mark, etc. But what we believe is, if you build a good business, good numbers, remain profitable, then value will automatically build up. So those are our short and medium term goals which we are running for, and that's what we are working on. If we talk about 3 to 5 years goal, we really look at staggering number of 1 lakh crore worth of disbursement through lending club platform. Now when I say that, that will be a gamut of a product or a product basket, wherein we will have multiple loan product, multiple investment option we will be providing to investors. I believe so far P2P lending has been seen as a very plain vanilla instrument, wherein we also offer two loan product, one for salaried, one for small merchants, and on an investor side also it is plain vanilla. But what we believe is there is huge scope of doing a lot of innovation on both the side. So there are more structured products can be created as and when RBI also allows us to get into secured lending, etc. We believe that we'll be able to bring a lot of required innovation in that sector. On the investor side, at this moment, we are delivering better returns from a normal bank FD product or debt mutual fund. Again, there also we believe that it's more of plain vanilla product where there is tenure based investment option, 12 months, 24 months. But we believe that there is so much of innovation possible around that as well, with different kind of tenure, different kind of risk based investments, etc. And that all will come up within next 3 to 4 years time period, and we are here to build those product. So in terms of vision, what we look forward is that government of India has already published a white paper on digital bank. We believe that we are already a quasi bank, wherein we have investors who bring capital to the platform. We have borrower who takes money from the platform. So it's a quasi banking that one person is giving money to another person. And who else could be better entity than become a digital bank, because our operations are 100% digital, right? But our definition of banking is little different than a traditional bank, that we don't want to control the capital. we definitely want more and more capital to flow within this ecosystem, the lending ecosystem. That if there is idle capital, that should go to people as a credit. So how we can build that is using right technology, right transparency. That if we are bringing capital to the platform, 100% capital should be allocated in terms of loans. So we don't contain the capital like what general banking system contain, like 22 to 25% is always maintained as a liquidity or CRR, etc. So this is completely different form of business, and our vision of banking is that 100 rupee came to the platform, that should be given to as a 100 rupee to different people. And I think that will release lot of idle capital availability in the system and probably help lot and lot more borrowers who are seeking for credit.
That's a wrap, ladies and gentlemen. Click on the FinTech Diary tab to view our previous episodes. If you liked it, please don't forget to share it on social media. Also, please ensure that you have subscribed to our daily newsletter, which is absolutely for free. Thank you so much for watching.